Hey everyone, welcome back. Today's video we're going to be going over how to make a trade plan. I'm going to show you the simplified approach I use, and then I'm going to link a couple of my YouTubes in the description that'll help you build yours. That'll kind of explain everything. And if you already haven't, go ahead and hit that subscribe button. So this is the kind of simplified model I follow. Orderflow internal versus external. I made a video on this. Super simple, super short. It's definitely worth checking out. Last liquidity taken, trade away from it. I made a video on this as well. So this is pretty much the last two YouTubes I made. So if you combine those two with what I'm going to show you today, it's going to make life pretty simple for you. So first off, follow confirmed ranges and don't try finding tops or bottoms. Enter moves on price that's already moving, which comes in the shape of large imbalance candles or vector candles. Vector candles is 3 or more imbalance candles in a row. It's just a measurement of momentum. So if we look at US 30 on the daily, it's obviously bullish. Your range goes from here to here. So daily's definitely bullish, no question about it. For those of us that day trade, this time frame's not going to do a lot for you most days. So what we need to do is assess this whole area. I personally use the 1 hour. A lot of you may find 4 hour works for you. It honestly makes no difference. By the way, today's Saturday, so this was yesterday's PA. I took this buy here. I'm going to show you how I worked up to that. So very simply put, this is our last 1 hour external range. Again, if you don't know the difference between external and internal ranges, I made a very detailed video about it. So that's something for you to check out. So again, if you look how we're stuck inside this range, these externals are not doing you a lot of good. So now we gotta go to a smaller spectrum, which is our internal ranges. And for me, internal would be, this would be kind of your last breakdown. Maybe what we'll do actually, instead of lines, we'll just use a couple of dots. So if that's your last breakdown, price pulls back. You could say price is bearish at this point. Here we get one bullish, could be a liquidity grab, could be nothing. Now you are confirmed bullish at this point. So 2 in a row is confirmed. You get one breakdown here. We know, as per our internal versus external video, that one grab down is likely a liquidity grab. We don't change bias. So if we just follow this price action, again, you get one bullish. So if the bullish is followed after it was already confirmed bullish, to me this price action is now bullish. And again, if this doesn't make sense to you, watch the internal versus external video. It's super simple. So this would be my last plain range. So by the way, I use Fusion Markets, but because Fusion is one broker, what I'll actually do is check out a bigger broker. In my case, I will use Oanda, and the reason I do this is sometimes these price lines end up being a little bit higher. So if I just go to Oanda quickly and show you what I mean, you can see Oanda actually took this high. So essentially, Oanda's kind of confirming a buy even more for me. So now, if we go back to our trade plan, what does our model say? So follow confirmed ranges. I would say that's bullish for me. Don't try finding tops and bottoms. Very simple. I'll show you how to do that in a sec. Enter price, that's already moving. So these 2 points kind of go together. So the next point I want to make here is last liquidity taken. Trade away from the medium or major liquidity points. You can check out the liquidity and inducement video for this. It's also super simple. So if I just look at this, my last liquidity taken would be here. So if we look at this, does this line up with the bullish ranges? Yes, it does. Can price still sell? Absolutely. That's why we manage risk. But to me, the higher probability move is still buys. This also goes in line with the bearish DXY ranges we have. I do have a video on that too if you're interested in checking it out, but that's not really important. Essentially, we want to be trading the opposite direction of DXY. So DXY is just dumping dollars being sold off. Therefore, it makes more sense to buy indices. So if this is my last liquidity reaction and my last range is bullish, my expectation is to take this high out. Daily liquidity, target, daily target. Quite simple. Now, I don't want to find bottom. And we know that a lot of times initial reactions are inducement, so I never take the first reaction. It rarely works out. I would say over 50% of the time, if you take this buy, you will lose. It's kind of a 50-50 chance. So rather than that, I wait for price to show me a liquidity cycle, which is also in the liquidity video. So there's your liquidity being built. So liquidity being built, you induce into the daily low. So right here you can see how this is the first retail manipulation. So what they did here is they took this out with a body. On the lower time frame, the whole world started buying here, but we know better because we know the initial reactions are often a trap. So essentially now we find the last inducement. So the last inducement is this point here. That's again in the liquidity and inducement video. So if I want to confirm a buy rather than finding bottom, I wait for this high to break. You find any imbalance, and essentially anything in this region becomes our trade. So the cycle is always the same. It's gonna build liquidity, it's gonna induce. If they want to go higher, they'll induce lower. Sometimes they'll induce both sides before the real move. So here, you reacted from this, you created a fake reaction, you gave people a boss or a chalk or whatever you want to call it, and then you liquidated them. Price goes sideways, which is the first clue that US 30 is reversing. It's just a US 30 pattern. If you want to live on the riskier side, this entry is okay. If you want to live on the safer side, you wait for candles to show you momentum. So this is 5 minute. If you want to clean it up a bit, we can go check out the 15. So the 15 is very similar. Still comes to this same imbalance. So I took this buy yesterday. Very simple. And you just cover a little bit below. So TP1, which would have been a fine TP here, I didn't end up TPing there. I just broke even there. I'm going to hold this to the daily. So this will go either go to target or break me even, which is totally fine. To me, daily liquidity will likely seek out daily. In the event that doesn't happen and price does not respect this liquidity and does that, that's telling me that order flow is actually being protected from this side and will be shifting bearish. I won't actually know this until this low goes, or if we come in and price starts doing something like this and it's all substructure going down, I would follow this until it fails. Again, this is all in the external versus internal order flow video. So fundamentals. So yesterday was NFP. NFP came out better than expected for the dollar. However, unemployment is higher. So what that means is the data is very mixed. When it's mixed, I don't really look at the fundamentals as useful data. It needs to come out one-sided. So to show you guys what that looks like, we'll go to calendar. So NFP, you could see this came out better than expected. This came out worse. What this does is creates a mixed data report. So what I like to see is both of these numbers red, or both of these numbers green, or if one is red and one is green, I want to see one like way higher than expectation. So to give you an idea, like this was forecasted at 191K, came out at 206. Yeah, it's a bit higher, but it's nothing crazy. Let's say this number came out at like 350,000 and NFP beat expectation by almost double. In that case, I would completely ignore this and I would be mainly looking for sells to line up. In this case, we didn't have that, but that's what I mean by one-sided data. So if we come up ISM, bearish, unemployment came out about the same as expected, ADP came out bearish. So all this stuff happened on the same day. This is July 3rd. So everything said the dollar was bearish that day. So everything that day should have pointed towards the US 30 buy. So if we go back to July 3rd, you didn't really set up for a very nice buy, but this was possible to buy based on fundamentals. I likely wouldn't have caught this, but fundamentally wise, this made sense. So that's kind of how the fundamentals ties into it. The rest of the plan's pretty simple. Market rhythm. So there's a couple ways of using this. This can get pretty complex. I'm just going to show you the simple version of it. The rhythm for me is what the last few days have been doing. So if I look at here, this range came below the 50. So I'm looking for a reaction below the 50 if I am to continue. So if I pull this as the last low, that goes to the last high, I wouldn't dare enter this anywhere up here. I would wait for the entry to come below the 618 and match this rhythm. Does it work every time? No. Does it work a lot of the time? Absolutely. So there's a couple ways of using this. Another way would be if price is going sideways and you reacted. Whoops, let's do that different. So price is kind of going sideways and you reacted. So again, I measure this. The reaction came from the 786. If we're looking at the price action as a whole, we can kind of tell we're consolidating sideways, maybe sideways and up. So with this knowledge, I know that if a buy presented itself here, I can buy deep into this range based on the market rhythm. So I would pull this reaction, and if I caught a buy somewhere here, I would hold to the 786. It's the same thing if the market is trending. So if the market does something along the lines of this, and it pulls back to, let's say, the 382 and this, my expectation is for this to only pull back to the 382 and not touch the 50. So this is telling me the market's trending. So when US 30 and gold trend, they generally don't come back to the 50. They're above the 50, more around the 382 or 236 mark. So when you have this kind of knowledge at hand, you expect not to wait for price to come down here. Instead, you look for price to react here. I'll show you an example in gold. It'll kind of make sense. So the rhythm matters for my entries. The rhythm matters if price is consolidating, and the rhythm matters if price is trending, because there's different kinds of trends. There's efficient trending, there's deep mitigation trending, and which is usually more consolidation on these pairs, and there's the price is not pulling back to 50 trending, which is how US 30 and gold actually move if they're properly trending. So if I look at gold, and we just look at this reaction, you can see here price never pulled back to the 236. So what I would actually do is, since price is not really trending yet, you could kind of see that price never came down to the 50. Ultimately, price ended up shooting up. So what I would do is, so this reaction reacted, caused this reaction. I would say this is the reaction that got you going. So with that in mind, I know I'm okay to buy above the 50. So this was the July 4th bank holiday. So we actually bought this. I ended up closing this out around here somewhere before NFP, which was a good thing because this happened. So I closed this out, but with that knowledge in mind, if this didn't react down here, what I can do now, if this reacted around a 382, I can again look at this reaction. And I can look for an entry below the 382. This one came a little deeper, but we know when it's consolidation, you want to cover comfortably. So I ended up closing this out here. Following into NFP, my expectation is now, if this is your reaction, this is where price goes, do I expect this price to come to the 50 based on how price is moving? Did we come back to the 50 here? We did not. We reacted above. This reaction here, did we come below the 50? We did not. So do I, under any circumstance, expect price to come down here to continue up? I definitely do not. So we ended up buying gold again yesterday. And our buy was right here. So we ended up putting a limit here, I believe. I covered this, price came, tagged this in, and we targeted something up here. So the way this worked for me is if I looked at this as my expansion from NFP, I know there's a good chance that my order is going to happen in this zone. So I know that if I put an order here, there's a good chance if the market follows the same rhythm, I can just buy this. I don't expect price to come down here and react because that's not how gold's been acting the last few days or the last week even. So that's kind of how the market rhythm part of the trade plan works. Super simple. Entry and exit, hold pro trend moves, and TP counter to secure profits faster. So a couple weeks ago, I actually sent this out to the free group. No, not a couple weeks ago, last week actually. I sent this trade out to the free group, and I got in here. I think I sent the signal to the group around here, around Asia. So I gave this trade out, and I did this. Where's this? Actually, oh, here it is. So I gave this tool out, and I said this would be TP1, and then I said this would be TP2. So the reason I did this is, to me, at this point, price is moving down, so this will be a counter trend move at this point. I know that price doesn't have to go much past the 50 of the range, so I said basically TP1, and then TP2 would be the nearest liquidity, which would be this liquidity cycle as well as Asia high. So I said TP1, TP2. I TP'd a TP1 myself, because at this point price could have did this. We didn't have any bullish order flow established yet, so that is TPing properly. So whereas if price, let's hypothetically say this is your range down, and price came into here and reacted and started going down. If I take this sell here, I don't have to worry about TPing at 50 of this reaction. We're pro trend, so at the bare minimum, I'm going to run this. I'm going to maybe even consider running this. And that's kind of how the TPing works. So you don't want to be reversing. Risk management, that's pretty simple again. Don't over leverage, use stop losses, don't lose too much in one day. So that's as simple as it can be. You don't have to complicate it any more than that. I'm going to link this YouTube video in the description for you. I'll link this one as well. And you can kind of use this video and those two to put this together It can be pretty simple. It's not going to be simple every day. It's only simple if you wait for the price action to align. And if you're doing it right, you likely won't find a trade every day. So yeah, I hope you guys enjoyed this. I hope you took away some value. If you have any questions, definitely feel free to ask me. And if I can give you any advice or help you, I definitely will. Yeah, I'll see you guys in the next one.